Good afternoon and welcome to another Fireside Chat hosted by Credo Wealth. For those of you that don't know us, Credo is an independent wealth management business founded in 1998 with around 3.7 billion sterling in assets and over 6,500 clients across the UK, South Africa and the rest of the world. So I'm Ainsley To, head of multi-asset based here in London. And it gives me great pleasure to introduce our guest today, who will be back shortly. Anatole Kaletsky began his career as a full-time journalist, writing for The Economist, The Financial Times, and The Times, where he was economics editor and editor-at-large, winning numerous awards, including Newspaper Commentator of the Year, Economic Journalist of the Year, and Specialist Writer of the Year. He's now a member of the governing board of INET, the Institute for New Economic Thinking, as well as a columnist for Reuters, and also a contributor to Project Syndicate and Prospect magazine. He's a co-founder of GavCal Dragonomics, and his book Capitalism 4.0 was nominated for the Samuel Johnson Prize in 2011. So, Anatole, welcome.
Hi, thank you, Ainsley.
Thanks. So you're joining us from Italy. How are things going over there?
Yes. Well, I have a house in Italy. I have had for the last 10 years, and I spend most summers a month or two here. And I've got to say that considering that this was where the whole COVID epidemic in Europe first hit Europe, and also that Italy has been the weakest economy in Europe, actually the weakest economy pretty much in the whole world for the last 10 or 15 years. Conditions are pretty good, and actually surprisingly life has returned to normal, and I'd say it's more normal here than it was in London just over a month ago when I left. You know, the restaurants are open, they're actually pretty full, museums are open, streets are full of, in the evenings, the Italians always take this so-called passeggiata when they go and walk up and down the street. And the main difference is that nearly everybody here is a local now, as opposed to the American, European, South African tourists that would normally make the place tick. And I think we're seeing this in a lot of other places around the world. At least to some extent, the local tourism, the so-called staycations, are replacing some at least of the vacation incomes and jobs in the last month or so, at least in those countries which for the moment seem to have got the COVID more or less under control, which certainly they have in Italy. The other thing that's very striking here, much more than in Britain, is that they're very rigorous about wearing masks. If you go into a shop, a bar, a cafe, you put the mask on. Actually, most people take them off as soon as they sit down, but sort of symbolically, it's recognized that you should be doing something about it. So that's probably a longer answer than you expected on the conditions in Italy.
Well, it's very interesting. I mean, my family are from Hong Kong, and obviously the culture of wearing masks there is been embedded for a little while since sort of SARS. But whereas, as you mentioned, in the UK, it's maybe there's sort of differing views and opinions about masks.
Yeah.
So Anatole, I'm going to speculate that we have something in common, and that's that when people who've seen your full name before they've heard you speak, they're somewhat surprised by your British accent. So it'd be great if you give us a little history about the beginning of your personal journey, from being born in the former Soviet Union to how you first developed your interest in economics.
Well, I was born in Russia, in Moscow, but I was lucky enough, and my parents were lucky enough that they had a chance to leave sort of legally without being refugees or whatever when I was only 5 years old in 1957. This was part of a temporary and very slight liberalization of conditions, which happened when Nikita Khrushchev took over and sort of went through the de-Stalinization period, which, you know, some of your viewers may be as old as I am and sort of vaguely remember that period of late 50s, early 60s. So, but after that, I lived, and my family lived in many countries around the world. We lived in Poland for a while. We lived in Australia I was actually first went to school in Australia. Some people say I still have a bit of an Australian accent. Other people in England actually say I've got a South African accent because of the mixture of all this Australian and Eastern European and so on. My parents, who were both academics, moved from Australia to England in the late 60s, where I was educated at high school, went to university. And my interest in economics really was from the time that I was a teenager, partly, I suppose, because of the background of moving from, one politico-economic system to a very different one. Politics and economics were always one of the big subjects that we were thinking about and talking about in my household. And in the 60s and early 70s, it became very clear, that was another period of economic and financial turbulence, upheavals, very different from the turbulence of upheavals today. It was all about inflation rather than deflation and so on. But it was a period when you felt that if you wanted to understand what was going on in society, in politics, in the future of the world, you had to understand economics, because it seemed as if the big currents in public life were driven by economic cycles, economic upheavals, strikes, inflation, unemployment, balance of payments crises, currencies collapsing. In the case of Britain, going through several devaluations, which were considered at that time in the late 60s and early 70s very traumatic events. A devaluation of only, I think it was 12% in 1967 in Britain was viewed at the time as the biggest economic crisis the country had faced since the Second World War. So one felt, if you wanted to understand what was going on, you had to understand economics. So that's what I went and studied at university at Cambridge first, and then I did an undergraduate degree at Cambridge, and then I spent 2 years in America at Harvard doing a master's degree in economics there. So that was my background. I guess just to round that off, I was quite good academically, and I originally studied mathematics, in fact, as an undergraduate at Cambridge. So I had that quite strong academic background. I thought possibly of becoming an academic, but after 6 years at university at Cambridge and Harvard, I realized that not only was academic life not for me, but specifically, and that's what's relevant, academic economics, as it was done even back then in the mid-70s, seemed to me too abstract and too detached from what was going on in the real world for me to engage myself. So after doing a master's degree at Harvard, instead of going on to a PhD, I looked for a job where I would be able to apply some of the knowledge to understanding the world. And I was lucky enough to get a job on the Economist magazine as a junior staff writer, and that was really the beginning of my career, first of all, for 25, 30 years as a full-time journalist, and also as a sort of economic, political thinker engaged very much with what's going on in the real world.
And we certainly look forward to diving into your sort of economic philosophies and how you see the different schools. But you spent so long as a journalist, and you've been such a prolific writer for such a long time. Is that something that came naturally to you, or?
Well, it was something that I had to learn on the job. I mean, as my education was really in science, as I said, I actually did my undergraduate degree in mathematics at Cambridge, and in British universities, the university degree is very specialized. You only do one subject. So for 3 years, I didn't write a single essay or anything. I just, did formulae and proofs of equations and things. And I really had to learn writing on the job. But I'd always been a big reader, been very interested in politics and current affairs, and so it was something that I picked up both through doing 3 years then after that of postgraduate economics, but in those days even, and now even less, doing an economics degree doesn't involve much writing either. An awful lot of it is actually formulae, calculations, proofs, and things like that. So it was really my job on The Economist, and then 3 years later on the Financial Times, where I was for 13 years, that taught me both, I think, how to be a clear writer, I hope a reasonably interesting one, and also how to work pretty fast, which you obviously have to do, especially on a daily paper like the FT was.
Certainly, and during your time there, relative to now, obviously now you're a writer in many different guises. Switching gears with your writing with Project Syndicate relative to GavCal and all these other target audiences, if you like. Maybe do you have a specific process for that, or is it?
Well, the sort of now for the last 10 years, the overwhelming weight of my work has been what I do for GavCal, which is the economic consulting business that I formed now 19 years ago in 18 years ago in 2002, with two partners whose background was from the asset management industry. My partners are called Charles and Louis Gav, and that's why, hence the name. They had a company called GavCo, which I joined, and my name was added to it. And I often say, because I only own 25% of the company and they own 75%, I only got one syllable of my name attached to it. That's what I do most of the time. And the other writing is just to keep some sort of involvement in public life, and also to allow me to have a bit more contact with politics and policy-making sources than perhaps the average or the typical financial economist tends to have. But really now, in the last 10 years, I have become a full-time economist rather than an economic writer. Ironically, at the end of my career, I can finally call myself an economist, in the sense that that's how I make my living. People pay me money, our clients, which we have about 900 around the world, pay us GavCal, our annual subscriptions, in order to get our analyses, our views about economics and financial markets. So in a strictly economic definition of how do I make money, I'm now an economist, which I never was until I formed GavCal 20 years ago.
And for those in the audience that don't know Charles and yourself and Louis, you all have very, very different views of the world and the way you see things, and that's actually part of the beauty of the GavCal service. Can you talk a little bit about how you met and actually how you with such different views came together to
well, one of the unusual features of our business, which somewhat to our surprise has been a formula for fairly successful business, and we were nervous about this, is that we don't have a house view, and we don't feel under any pressure from our clients to unify all our analyses, which inevitably differ, because the whole point of markets is that they always consist of a clash of views, because otherwise the market price would not be where it is. At any given moment in the market, there's more or less by definition an equal weight of bears and bulls, because otherwise the price would be somewhere different that would lead to that equilibrium. So there's always a debate going on in markets, and that's what makes financial economics to me so interesting. But many firms, I suppose larger firms, especially ones that deal with retail clients, have to have, at the end of the day, converge on one view where they say, buy the euro, sell the stock market, buy bonds, in a uniform way, because that's what their clients are paying them for. Our clients, because they are all large, sophisticated wholesale institutions, they're mostly organizations like Fidelity, JP Morgan, Schroders, or aggregators like yourselves who serve retail or high net worth clients, but are themselves doing the analysis, which then turns into asset allocation advice for those clients. So our clients are not looking to us for a sort of specific, pinpoint recommendation: do this, do that. What they pay us for is to present them with ways of looking at the world, and an analytical framework and arguments, both for and against, which they can then weigh up for themselves and each come to their different conclusions about how that should affect their asset allocation, their expectations, etc., etc. So we do, the three founding partners, now we have about 30 people working for us as analysts around the world, and especially in Far East and China. We all have different views. Obviously, the weight of the views of the founding partners is somewhat greater than the weight of our junior analysts, but we try to encourage them also to put forward their own analysis rather than trying to squeeze whatever they believe into a sort of preordained mold of something that we impose on them. And, for a niche business, which is what we are, although we're sizable, but we're a niche business, that seems to be a successful business model. I don't think, you couldn't run a firm like Merrill Lynch or Fidelity necessarily on that basis. Although the final thing I'll say about that is that whenever I go in and talk to these investment institutions, which in normal times is the main job that I do actually now, is not so much writing, but the face-to-face interaction, which unfortunately hasn't been possible for the last 6 months. But when I go to these institutions and there are 5 people or 12 people or 20 people around the table, what we almost invariably find is that they internally are having exactly the same debates amongst themselves as we've been having between ourselves at GavCal. And most of the time, at least, they find it valuable and helpful, when we present those debates to them, for them then, to assess and weigh up in whatever the way they like. The way that our firm was formed, which is also sort of relevant to this. I mean, we don't disagree just for the sake of it. Basically, I'm a Keynesian, and my partner, Shalgav, is very much a kind of Thatcherite, Thatcher-Reagan monetarist, who believes in completely untrammeled free markets and so on. Whereas I have more faith, I suppose, in both government macroeconomic policy in terms of demand management, and also in some areas in government intervention to achieve particular objectives. So we disagree in a lot of philosophy, but there was one thing that we strongly agreed on 20 years ago, which was the currency markets, and particularly the euro, where we both thought that the creation of the euro was a very, very big mistake for the European Union. And the way we met was that I was running a small consulting business, really as a sort of moonlighting operation while still being primarily a journalist. And I was working for a number of hedge funds that I'd met in my years in New York, working for the FD, Soros, More Capital, Tudor, and Charles had other clients. And we had one client in common, which was the Singapore Government Investment Corporation, who were at that time the 3rd or 4th largest currency reserve managers in the world. And they had a seminar in 2001 to discuss the euro, which had just been formed as a permanently fixed currency at the beginning of that year, to discuss whether it was sustainable or not. And they had a debate, and they had Charles and me on one side saying, no, the euro isn't going to work. And they had another 2 economists on the other side. And that's how we got to know each other. And we do have that in common. I think the euro was a big mistake, but even now, although we both think now we've come to a disagreement, because although I think it's a big mistake, creating it was a big mistake, it's probably here to stay. Because I guess the other thing about my philosophy of life generally is that there are many, many things in the world that are imperfect, and in fact, in many cases, highly dysfunctional and damaging, but it doesn't mean that they're going to disappear. And you have to learn to live with them and work around them. And I think the euro is one of those. And gradually over time, if you're lucky and the world is lucky, the dysfunctional things gradually improve. I think that's what's happening with the euro. My partner Charles thinks that it's so dysfunctional that it's going to break down, it's going to blow up the European Union, and the EU itself has become such a counterproductive institution that it will split up. So we even argue about the euro as well.
Yeah, no, and from attending your seminars, I noticed you guys even disagree on how you pronounce Keynesian. So it's that use confusion. But I mean, on that point, and maybe we can frame the conversation with today, given the pandemic and how things may have changed. Market fundamentalism and those views relative to a more interventionist sort of policy. I think Bernanke's book after 2008 was called The Courage to Act, whereas from my armchair, it doesn't feel like that at all this time around. The courage is anyone not acting is really imposing a lot of political risk on themselves. So do you in terms of your philosophy relative to maybe Charles's on intervening during this crisis and all the stimulus that's been injected? We'd love to.
Well, first of all, I think what's more important, especially if you're in the financial markets, than whether you think something, in terms of philosophy, what's more important is not whether you think something is the right thing or the wrong thing, but whether you think it's going to happen or not going to happen. And so I would say, your question about a more active government and more interventionist government, there are two aspects of it. One is it actually a good thing? Is it likely to make the world a better place, the world economy stronger or weaker? That's an interesting question. But the second question, and I think the more important question for financial markets, is this something that's really happening, regardless of whether you approve of it or not? So I prefer to start with that second question, because I think the answer to that is very, very obvious. And this is the point you made, Ainsley, that 12 years ago, into the 2008 financial crisis, there was a big controversy about whether first the US government and then the European governments should write the checks required to prevent the entire world banking system from completely imploding. And it wasn't just about bailing out bankers, it was actually about bailing out the people who had their deposits with the banks. And this is a point that, to my astonishment, is still missed 12 years later. People say, oh, well, the government's just bailed out these bankers. Sure, they did allow some bankers to keep their jobs. But the main thing is they prevented all the people with deposits in banks from losing all their money, which is what happened in the Great Depression in 1929, 32. So, but there was a big controversy about whether that would happen. And as you said, the sort of default assumption, at least philosophically, was no, governments shouldn't do anything unless the world is on fire, and when they did do something, it had to be the shortest, sharpest intervention possible, followed by a reversal. And that applied certainly to governments with their sort of tax finance bailouts of banks and so on, and even to central banks, which, there was a big debate about should they do quantitative easing, should they buy government bonds? And of course, they've now been buying government bonds for 12 years, but when it was introduced, it was a very temporary measure. We'll do this for 6 or 9 months, just until the crisis goes away, and then we'll go back to the more detached passive conditions. Now, whether we like it or not, the assumptions are completely the other way around. There is a problem. If there's a problem, the government should do something about it. Now, if you're a right-wing government like Trump or Boris Johnson, you say you do one lot of things. If you're a left-wing government, you say you do something else. But there really is there's almost no space on the economic spectrum for the old-fashioned sort of Thatcher-Reagan small government types, or the libertarians who say, no, let's just stand back and just see what happens. So I think in that sense, we are now in, and this is what I think is very important for financial analysis going forward, is that we are now in a different policy regime from the one that prevailed certainly up to 2008. And even in the period between 2008 and COVID this year, which was an 11-year period, a great period for financial markets, very bullish, not such a great period for the world economy, but not terrible, some recovery in the world economy, but not great. That was a sort of transition period from 2008 to 2020, when governments and central banks were becoming more and more activist, both in managing demand, preventing unemployment and so on, and in intervening in particular sectors, starting with the banking sector, but then kind of moving to other parts, to other areas. They were becoming more interventionist, but they weren't quite willing to admit it. They're always saying, this is just a temporary thing, this is an emergency measure, we're going to go back to the laissez-faire system. I think that has now been definitively changed by COVID in 2020. And this is why I think that we're now in you mentioned at the beginning a book that I wrote back in 2010, which I called Capitalism 4.0, which was about this whole process, which I thought would occur as a result of the financial crisis. I did see that that was the end of a 30-year period of this laissez-faire, hands-off, non-interventionist government. I thought that as a result of the crisis, of the 2008 crisis, we would get more government intervention, both in macroeconomic policy, in currency markets, and in sectors, environment, etc., etc. But I also thought, looking back through history, that it would take a long time, and there'd be a long period of confusion and uncertainty, while this new philosophy sort of gradually evolved, when people would still believe that they were living in the old world, while the reality was gradually adjusting to the new world. And this reminded me a lot of the period that I mentioned earlier, from the late 60s to the early 80s, when, by 69, 70, it was pretty obvious that the Keynesian government interventionist policies that had worked, frankly, brilliantly for about 15, 20 years in the 50s, 60s, in Europe, in America, in Japan, were failing. They had broken down as a result of inflation, strikes, etc. And gradually, public opinion and politics was swinging in the direction of laissez-faire, anti-inflation, inflation, getting inflation down is more important than keeping unemployment down. Stricter, more rigorous, much more rigorous budgetary policies, all that kind of thing. That was gradually happening, but it took about 10 years for that to become fully obvious and sort of recognized in politics, basically with the election of Margaret Thatcher in, I think it was June 79, and then Ronald Reagan in November 1980. So this was like a 10 or 11 year period of transition. Now, I think at least what's possible, and to me, perhaps if there is a fundamental, a credible fundamental explanation for the stock market, incredible stock market performance of the last 3 months, which is literally incredible in the sense that I certainly didn't believe it was possible. But if there's an explanation for it, is that I think that perhaps the markets are getting the sense that we are now rather at the beginning of a collapse of, an economic model. We're at the end of a transition period, which has lasted for 12 years since 2008. And what emerges from that may well be a more coherent relationship between fiscal policy, what central banks are doing through monetary policy, a more sort of interventionist government, but in some sectors, but one that is where at least it's recognized what it's doing. It's not just doing it by accident, it's doing it in accordance with some kind of medium-term plan. And in the long run, that may or may not work. Now, my partner and most people I talk to in financial markets think that if that happens, it'll be disaster. It'll lead to socialism, creeping socialism, rigidity, inflation coming back and so on. And that may be true in 5 years' time, 7, 10 years' time. But for the next 2 or 3 years, I think there's a pretty decent chance that that will actually lead to a stronger economic recovery than anybody thought even possible 6 months ago in March. Certainly, I didn't think that the strength of the economic recovery, which I think we could see next year, was a possibility. But now I do think that, and I think that is what the market is at least betting on. Now, whether they turn out to be right or wrong remains to be seen. Maybe we'll come back to that in the discussion.
No, absolutely. No, maybe what would be good that you mentioned briefly in terms of your hinted at your current views, but that they've obviously been on their own path since the beginning of the year, and obviously you've written a sort of a mini mea culpa piece, which is fantastic recently. So maybe we can start there at the beginning of the year, your views and sort of what were the main points that sort of changed those.
Yeah, so the piece that you mentioned, which we did for the GAVCAL clients, and I've written publicly another version of it. I called it "Why I Was Wrong to Turn Bearish." Now, and so one thing I learned as a journalist actually is that the readers love being told that you were wrong. That they love somebody starting off saying, "I was wrong." And what I used to do at the times where I was for 20 years, and I wrote a weekly column on economics as well as one on politics for the last 10 years, at the beginning of every year, I would write a column saying, these were the 5 things that I got wrong from last year. And that was always the most popular piece. But obviously I would adapt it to make myself not look completely stupid. But so I wrote this piece saying, why I was wrong to be bearish. Now, just as a preface to that, it was called "Why I Was Wrong to Turn Bearish," because for the previous 12 years, ever since the end of the financial crisis, I had actually been very consistently optimistic about the outlook for equity prices and risk asset prices in general, really from the middle of 2009, when once the American government had thrown the money in, the fiscal money in, the government had done money with TARP, once the Fed had said, we're going to buy up all the government bonds, reduce interest rates to 0, I actually thought this crisis is over. And a lot of people then were still saying, no, the big one is still to come, the second shoe hasn't dropped. So I've been consistently bullish throughout the last 12 years. And even, during sort of mini correction, well, not mini, serious corrections like the China crisis of 2015-16, the so-called taper tantrum, when the Fed actually started tightening policy, I think it was in 2013, I kept saying, well, after a 10, 15, 20% fall, you should be buying the dip. I was very tempted to say that again in February this year, because I could see this COVID thing happening, and I thought, well, it's not going to be that serious. Maybe a lot of people will die, but actually, financial markets don't really care about people dying. They're very cynical, and they're only concerned about what's going to affect the economy and the ability to make money. So my view was that the mere fact that 50,000 or 100 or 150,000 or even 500,000 people are going to die around the world of this disease does not really justify a collapse in asset prices, which, after all, should, in principle, reflect what is the long-term profitability, what is the long-term capacity of a business like, Apple at one extreme or British Airways at another extreme to make profits, to make a living over the next 5, 10, 15 years. And so even if they suffer a big hit in year 1 or year 2, if it doesn't actually completely break their business model, why should this cause a slump in the share price? That was my initial inclination. But then when I saw by the middle of March that it wasn't just a question of how many people were going to die or contract this disease, but that the attempt to stamp out the disease was going to totally close down the world economy in a way that we had literally never seen before, and that the epidemic, the medical side of the epidemic, was bound to get worse before it got better. Because, for a while, like most people, I thought it might just be confined to China and, a few unfortunate countries like Italy, which had got it, but it wouldn't spread it. But when it became clear that it was spreading everywhere and every part of the world economy was going to close down, I'm afraid I panicked like everybody else. And I thought, this really is a shock to the system on a scale that we've never seen before, certainly not outside wartime. And therefore, even if it might be in some way rational for investors to sit back and think, well, how will this affect the business that I own in 3 years' time or 5 years' time? First of all, they won't be making that decision when they see more and more countries close down, more and more economic data showing not just a full, but a completely unprecedented collapse of economic activity. People won't have the self-control to take that very long view, number one. And secondly, for a lot of sectors, it won't be possible to make that long view because, if they suffer a hit of 80% of their revenues, then, even the best, the strongest travel companies or hotel companies or entertainment companies will actually go bust. So yes, the successor, a new airline may be created to replace American Airlines or British Airways in 2 or 3 years' time. But meanwhile, the shareholders in those will be completely wiped out. The same goes with cruise lines, hotels, casinos, very large parts of the world economy. So I thought, actually, this is really going to get a lot worse before it gets better. And therefore, I turned, obviously the market moved ahead of me. By the time the market was down 30%, what I was saying to clients, and actually this is an area where we all agreed, all the partners agreed, we were saying, well, it's too late to sell now because obviously it would have been better to sell 3 weeks ago. It's too late to sell, but it's much too early to buy into this thing because the worst is not over. The worst is still to come. And it's very unlikely, although in theory it's possible, that investors will simply look through the terrible news that lies ahead to the sunlit up plans from the end of 2021 onwards. And therefore, I turned bearish. Now, with hindsight, I was totally wrong because actually, we had one of these big webinars for about 200 of our clients. I think it was on the very day that the market bottomed, the 20th or 21st of March. And I said exactly that. It's too late to sell, but it's too early to buy, at least in the equity markets. What I did say and what I did get right is that it wasn't too early to buy non-dollar currencies, because you may remember that in March, it wasn't just the stock markets collapsed, but all the currencies, not just the emerging market currencies, collapsed, like the rand and the real and so on. But the euro was down to 105 against the dollar. The pound was down to, I think, 112 at the low against the dollar. So all the currencies had collapsed as well. And I did say, well, on the currency side, it's probably not too early to buy the non-dollar currencies, because the crucial difference, in my view, then between currencies and equity markets was that a currency is always a relative play. You don't have to have the world improve for the euro to go up against the dollar. All that you need is that the improvement or the deterioration in Europe should be slightly less than the deterioration in America. They could both be getting worse, but so it's a relative play. Whereas for the stock markets, my view was it's not going to turn around at least until there are some signs that the worst is over. Now, that turned out to be completely wrong. I'm sorry, this is a long answer, but and what I tried to spell out about why I was wrong to be bearish, which I think is still relevant today, was why in hindsight was that a mistake, which of course would have been nicer to recognize at the time, but in a way it was not possible to recognize at the time. And really, I think there were 3 reasons for that. First and probably foremost, was that within a month of that market bottom at the end of March, the scale of the government spending that was brought to bear in every major economy of the round world was so far beyond anything that had happened before, and frankly, beyond anybody even a few weeks earlier imagined was possible, that I think it was actually sort of objectively unrealistic and objectively invalid, wrong, to predict at the end of March that actually there even could be an economic rebound, because for that economic rebound to happen would require government spending on the scale of 10, 15, 20% of GDP. And, I actually wrote a piece for GovCal saying, a week after this bottom, saying, well, the one thing that could happen to turn this thing around would be every G7 government around the world would have to spend and therefore borrow from the financial markets at least 10 and probably more like 20% of GDP this year. They could get away with it. It wouldn't cost them much. If they did that, it might just work to turn around the world economy. But we all know that's not going to happen. And therefore, the outlook is dismal. 3 days after I published that piece, the British government was the first, came out with a package which was worth exactly, I think it was 12% of GDP. And the other thing I said is, and the way they could spend that money, but again, this is not going to happen, is they should write government checks for everybody who's temporarily unemployed. They should guarantee at least 80 or 90% of their pre-COVID income from the government. Now, if that happened, then there wouldn't be the collapse in spending power and there would be a prospect of revival. But of course, that's not going to happen. And 2 days later, the British government did exactly that. And then about 2 weeks later, the US government said, no, 80% isn't good enough. We're going to write checks of 110% of what people were earning before. So the first thing was the scale of this fiscal intervention. I think that was much more important than the monetary policy of, although that was also important, central banks buying, was way beyond anything that could be imagined. Secondly, more briefly, rather to my surprise, investors decided that they actually believed in Keynesian economics. They actually, when they saw governments doing this, I as a Keynesian said, well, there's a decent chance, maybe a 70% chance that this will actually work, just pushing more money into the system. But I didn't think that most investors would agree with that, because most investors have spent the previous 30 years saying, oh, none of the government spending never works. But to my surprise, investors decided that it will work by next year. And of course, whether it will work by next year, I don't know. We'll only know next year. But until next year, there won't be any strong evidence that it hasn't worked. So I think that's another kind of now bullish factor. And the third was this much longer term possibility, and this is much more a possibility, that we are at the beginning of a regime change. And that regime change could, in my view, with say 60% probability, but maybe some people might say lower probability, could result actually in a higher growth, more profitable world, at least for the first few years, rather like it did after the Second World War. And that obviously we won't know about for many years.
Perfect. And you touched on something which is, I guess, an existential issue for forecasting markets generally, and that's the Keynesian beauty contest, having to anticipate the anticipation of others.
That's right.
And on your point about markets recovering, it'd be good to dive into the equity market in particular, and that the recovery in asset prices anyway has been far from uniform. And on our point about anticipation, maybe it'd be good to talk about the role of big tech companies in the recovery, and perhaps on a bubble logic, and whether you see anything going on there with Tesla and all the other tech companies doing so well.
Well, that's another reason why I turned bearish at the beginning or the second quarter of this year, which with hindsight was clearly wrong from a financial standpoint, but unlike the other ones, I think I will stick to analytically and intellectually. That especially in the early phases of the market recovery, it was totally dominated by really 5 or 6 stocks in the US, these sort of mega cap, Facebook, Amazon, Microsoft, Google, what's the other one? Apple, and of course even more Tesla now. And apart from those stocks, plus a few much smaller companies, which were actually rocketing even faster, but of course from a much lower base, so they didn't have the same income. But also, like there's a company called Nikola, for example, which makes electric trucks, or doesn't make electric trucks, says it is going to make electric trucks, similar to Tesla. Its name Nikola is derived from the name Nikola Tesla, who was the inventor of the light bulb before Edison, actually. And Elon Musk adopted the word Tesla, and so the guy who had previously worked for Musk, who decided to form this truck company, said, oh, well, I'll call my company Nikola. Basically, his only asset at the moment is the name of the company, but it's already worth, or at least at its peak, it was worth more than General Motors. It hasn't made a single truck. Okay, so you had these very, very narrow participation, and also among those rocketing stocks, some of them have genuinely very, very strong business models, enormous profits, enormous cash flows. They are the big five, Google, Apple, Microsoft, Facebook. But even those which have grown incredibly rapidly, but actually aren't growing very fast anymore at all. So Apple's revenues have actually not grown for the last 5 years. They've been up and down, but broadly speaking, they've been within a 10% margin for the last 5 years. Their profits have grown because they've managed to, retire equity, raise debt, at zero cost, and so on and so forth. So with a bit of financial engineering, their earnings per share have gone up, but also not spectacularly. But their valuations are not that high because their profits are enormous. So Apple's worth whatever it is now, $2 trillion, but it's actually making $200 billion in profits. Those are the rough numbers. So it's still on a very, very reasonable, or maybe it's $150 billion of profits, but it's on a reasonable PE ratio. But of course, those companies are now so big that they can't go on growing. They're not going to go on growing by 10, 15% a year. At the other end, you've got the companies which actually have no profits at all, like Tesla, Netflix, and the smaller ones, which are all based on hope value. And in both of those categories, you have, over the course of this year, companies of both those categories have gone up by anything from 40% to 500 or 600% during the course of this year, even as the demand for most of their products has fallen. I mean, I think it's pretty much impossible to believe that Tesla will sell more cars this year than it did last year, given the falls in activity in China, et cetera, et cetera. Sure, by next year it may be back up, but it's not going to be a good year even for Tesla. Maybe it will be for Amazon, or not even clear for Netflix, incidentally, because there are so many new competitors coming into the streaming business. So I felt, and I still feel, that part of the market is not. You can't value it. You can't justify its prices on the basis of any analysis of valuations. But having said that, I'm old enough, or more than old enough, to have experienced, very directly what happened in the late 1990s with the dot-com bubble and the first great internet boom. And I was already very involved in financial markets. It was before we formed GovCal, but I was running my own consulting business for a small number, but a very large, high-hitting hedge funds and investment institutions. And I was going in there every month, every 6 weeks, and everybody would be bashing their brains against, heads against brick walls and tearing their heads. This is impossible. This cannot go on. These companies are not worth anything like what the market puts on them, and then a month later they were up another 15%, 20%. So I would, and what I realized at that time, and it's quite a sort of humbling thing, is that in a situation like that, you feel that that the brave thing to do and the intellectually sort of challenging thing to do is to be a contrarian and say, no, the market is wrong, I'm right, I understand. Which may be objectively true, but actually that's the easy thing, because actually every other intelligent person you talk to agrees with that. This doesn't make sense, and therefore it can't go on. The really difficult and brave and the way challenging thing to do is to say, none of this makes sense, and yet it may go on, and it's likely to go on for another year or 18 months. And in the process, you might double your money. And if you're short, you're going to be wiped out. As Keynes famously allegedly said, the market can remain irrational much longer than you can remain solvent in some circumstances. So what's really challenging is to think about a situation, or to recognize a situation where the market is being driven by this sort of bubble mentality. And that doesn't make sense in terms of economic analysis or traditional valuations, but may nevertheless make sense from an investment standpoint, at least, obviously not to put all your fortune in, but at least to have some participation. And certainly it's very, very dangerous to fight against it and to be short there. So I think that was the situation we were in until recently. I think more recently, there has been a broadening of participation. And we're now seeing not the deepest cyclical companies, and not the sectors that are really being potentially wiped out by COVID and the hospitality, travel, etc. But we are seeing a broadening of into the engineering sector, into the construction sectors of this participation, which I think does suggest that for the market as a whole, it's not irrational what's going on. For the Teslas and Netflix of the world, I think it is irrational, but having fought it for so long, luckily not with a lot of my money, I would be reluctant to fight it, but one should always be on the lookout for any signs that the bubble is popping.
Perfect. No, there's so much we could go on to discuss, around the world in terms of asset classes, but I'm conscious of our time with you as well. So, I'd sort of like to end with a bit of the cuff question, and maybe you can talk about having achieved so many things in your career, what you define as success, and what advice you would give to anyone looking at pursuing macro speculation, should we say, in the coming years.
Well, yeah, gosh. I think. Well, first of all, I think in the financial markets and in finance, unfortunately, or fortunately, there's only one definition of success, which is what actually goes up, identifying what goes up and what goes down, and being on the right side of that and making money. Now, it doesn't mean that everybody can make money like Warren Buffett or George Soros, or start a bubble company like Elon Musk and so on, Elon Musk. But I think in a way, what makes that answer easy to financial markets, but also one of the things that makes it fascinating is the discipline of having a very, very clear definition of success, and you can sort of mark your work out of 10 every day or every week, depending on that. Now, how do you achieve that success? I think, there are long books written by people infinitely wiser than me that give advice, and yet actually very few followers of that advice, manage to achieve what Warren Buffett did by following Graham Dodd, or what George Soros has sold literally millions of books, but I don't think, and most of which have been bought in the hope of extracting some kind of advice on how to speculate in currency markets, but I don't think many of the buyers of those books have actually profited from them. So I guess I would just say two things connected with what I was saying earlier, is that I've realized as a result of now 30 years of experience that actually the trend is an important trend. Following does work more of the time and works better for most people than being a contrarian. Everybody wants to be a contrarian because it makes you feel better, it makes you feel cleverer to be a contrarian, and also it gives you the prospect of a very rapid, you buy something that's gone down by 70%, you buy it at the right moment, it goes back to where it was, you've doubled or tripled your money, very quickly. So being a contrarian can be very profitable, and it's certainly not. It's a strategy that should be part of the of the toolbox, but you have to recognize that being a contrarian only works at turning points. And most of the time, markets are not turning points. Most of the time, markets are in trends. Now, the other thing that I think that I've understood is why this trend following works. Most of the time, if you study economics, as I did as an academic at university, the only conclusion you can draw is that it can never work, because the whole point about markets is that they're already discounting all the information that is out there, and therefore there's absolutely no logic about a stock going up today and tomorrow, and if the news is good, it should have gone up by $5 today, and then it should stay there rather than going up by $1 on Monday, another $1 on Tuesday, another $1 on Wednesday. So why does that happen? The reason that happens is that even when reality changes and information changes, when objective reality changes, it's never obvious that that change has happened. And there's always going to be a range of views about whether the change has happened. And there will, most of the time, be a lot of people in the market who don't believe that the change has occurred, who still believe. So if you have a change in regime, like I was describing, for many years, people will still believe that we're living in the regime, for example, of inflation targeting central banks. Just last week, Jay Powell said the Fed is no longer in the business of targeting 2% inflation. It wants higher inflation than 2%. Most people in the markets will not believe that for several years. They still believe that deep down the Fed is trying to get 2% inflation. And therefore, if in fact the Fed is now going for 3% inflation, it will take many months or probably years for the market for everybody in the market to buy into that proposition. And as long as there are a lot of skeptics in the market, that's why you get a trend. And that's why trend following works. So I think that balance between contrarian thinking and trend following is, it's the only sort of advice that I can give, that neither one of them is the answer, and you've got to keep your mind open to both.
Having mental flexibility and an open mind. Perfect. Now, that seems like a great place to end it. So, Anatole, I want to thank you so much for your time today, and thanks to our audience for joining us. And until next time, goodbye and keep well.
Okay, thank you very much. Bye.